are listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
Joining us today on Industry Happenings is Joe Kamnik, Senior Vice President and General Counsel at the OCC. Welcome to the program, Joe.
Thank you, Joe.
How about if we start maybe with you telling our listeners about your background and your current role at OCC?
Sure, Joe. Prior to coming to OCC in October of 2014, I worked for the Securities and Exchange Commission, primarily regulating OCC and other systemically important financial market utilities. So I have a unique perspective on the goings-on at OCC.
Well, that's great. And I know that, in addition to the clearing organization for listed options, OCC has really taken on more of an advocacy role in the industry. Would you tell our listeners why that is?
Joe, we really view part of our role at OCC as helping drive the industry growth by providing thought leadership and education to policymakers, market participants, and the public about the products that we clear. It's fundamentally important for investors and policymakers to understand that option strategies, if they're properly used, can reduce risk and help investors better navigate the equity markets.
I think that is certainly where OIC comes in as well. I know that one recent example of OCC's advocacy in Washington was the Labor Department's proposed fiduciary rule. So why was OCC concerned about that rule?
We were concerned about the overall direction of the proposal, in particular the concept therein about creating different standards for brokers with respect to retirement and non-retirement accounts. I think we had two big concerns underneath that umbrella concern. The greatest one was that there are fiduciary and best interest contract exemptions within the proposal. And our read of the proposal was that it would prohibit investors' use of exchange-traded or listed options in IRA accounts. Our second concern was that under the fiduciary definition of the proposal, if an advisor to an ERISA or IRA plan made recommendations to the management of securities that are assets in the plan, then such advisor could be considered a fiduciary with respect to the plan.
So what was OCC's response to that proposal?
You know, Joe, our response was along three lines primarily. First, we worked with the U.S. Securities Markets Coalition, which is comprised of the listed options exchanges and other market participants, to recommend that the definition of asset under the rule be revised so that the best interest contract exemption was eliminated. And second, we also recommended that the final version of the proposal clarify that screening by a broker of the owner of a self-directed IRA account does not by itself constitute a recommendation as to the management of plan investments. And our third recommendation was that firms shouldn't be considered fiduciaries under the proposal simply because they provide educational outreach to investors.
Well, I mean, lots of detail here, and it sounds like the OCC's initiative and the coalition is extraordinarily important. What would have been the impact of the proposal on individual investors who traded listed options?
Well, the proposal read one way could have prohibited the use of listed options by self-directed investors in their IRA accounts. Now, some context around the importance of that possible prohibition. Individual investors, including IRA account owners, are significant participants currently in the listed options market. We estimate that nearly 15% of the volume on U.S. options exchanges can be attributed to individual investors. And our 2015 cleared contract volume was around 4.2 billion. So that's, if the math is right, a little over 600 million options contracts that result from individual investors. It's also our understanding from talking to brokers who cater to some self-directed investors that IRA account owners are increasingly using listed options in their retirement accounts, primarily to manage risks associated with owning the underlying stock. So as you can understand, it would have been a significant prohibition for the industry.
Boy, that's for sure. So in the end, what happened with the final rule as it relates to the listed options?
Well, we are very happy with the final rule because the Labor Department omitted the exempt asset list in the final rule, which essentially means that options and other asset classes can continue to be used in self-directed IRA accounts. This was a huge win for investors, and we're glad that we were able to play a role in that success.
Huge win indeed, Joe. Any lingering concerns on the part of OCC or the coalition?
You know, Joe, even though we consider the final rule a win for us, we do have some lingering concerns that we continue to evaluate as we study the rule. I would say primarily, at least based on our preliminary review of the final rule, we do have a concern that the final rule may limit the ability of brokers to educate self-directed IRA investors on listed options, because certain educational outreach opportunities may classify them as fiduciaries, as I mentioned earlier. So we continue to explore that, and we'll see what we can do about it.
Well, that would also be significant going forward. So I'm sure you will stay right at the forefront with any movement in that direction. You've done a great job here, Joe, offering a lot of kind of detailed information on what's happened in Washington recently. I appreciate you informing our listeners on that. And any final thoughts before we wrap it up?
Yeah, Joe, I think fundamentally we believe that giving individual investors the right risk management tools to help them save for their retirement accounts is more important than ever now. And as you and I talked about the numbers a little bit earlier, it's clear that individual investors have increasingly found options to be a valuable investment tool, whether it be by generating additional income or whether it be by protecting their stock holdings through puts. And if the fiduciary proposal had been finalized as drafted, investors would have lost the opportunity to use this valuable investment vehicle. So that's why we took on this advocacy role, and that's why we are thrilled with our success.
Well, Joe, that really is a significant success to be proud of. You're talking my language when you're talking income generation and risk management controls. So to our listeners, again, Joe's offered a lot of detail here. I would urge you, if you missed some of it in the first go-round, be sure to go back and check out today's industry happenings. Joe, thanks so much for joining us today.
Thank you for having me, Joe. Great to talk to you.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Steve Claussen, Chief Investment Strategist at OptionsHouse. Steve, thanks so much for making the time and joining us today.
I'm real happy to be here with you, Joe.
Well, these are busy times, and we really appreciate it. How about if we start by you introducing yourself to our listeners? Tell them about all your varied experiences in this industry.
Oh, that's great. I am a longtime veteran of the options trading community. I started in the pits in Chicago way back in the 80s, traded through the crash, and worked with derivatives pretty much my entire professional life.
What crash
after
was
migrating. That was the crash of 87, or it might have been 89, or it might have been 93. But any one of the multitude of crashes that investors have had to deal with throughout modern financial history. But after leaving the floor, I traded derivatives for institutions, for banks upstairs, internationally, in Japan and in London, and the derivatives business, and now being with a retail brokerage, OptionsHouse, and teaching folks how to employ options and to elevate their trading, and how options can change the risk profile of straight stock ownership has sort of been my focus.
Well, as I said at the outset, we're thrilled to have you because you bring this wealth of experience. And I'm sorry to interrupt there, but guys like us, when we hear references to the crash, of course I know what you're talking about, the 1987 crash. But as we present around the country and we refer to the crash, oftentimes people don't know what the heck we're talking about, and it just still blows my mind. So
absolutely,
my apologies for the interruption. Anyway. I really I think it's fantastic to have you here to talk about today's topic, which really is rolling option positions. We really haven't talked about that, with our audience yet, and so I thought you'd be the perfect person to maybe start by describing and defining really what an option roll is. How about if we start there?
I'm going to even start a little bit before there, if we can, and that's with the fact. And it's very basic, because I know the folks listening in here are probably a little bit more in tune with options trading and managing option positions. But where I really like to start is what I call the golden rule of options trading. And that is when a retail investor, when any investor utilizes options, a lot of times if they're new to the options trading world, they'll look at it and they say, oh, yeah, an option, it has an expiration, it gives me some rights, it gives me some obligations if I sell an option, and it has this expiration. So say if today I overwrote a call option on some stock that I own, and if I happen to choose the June expiration, a lot of people think, okay, I'm done. I'm done until June. And the golden rule of options trading to me, and what I present to our folks, is each and every day you can choose to close, to adjust, to trade out, to sell to close, to buy to close. You can choose to change the trade that you have on, to close the trade you have on, and maybe put on a more advantageous trade, or maybe put on a trade that does more about why you were in that first trade. And I know this is super basic, and most people say, well, of course. But I'll tell you, I can't tell you the number of times that people are sitting on positions that have a specific expiration still in the future, and they just sit there and look at them because they think, they're committed until that date. And what we're going to talk about today is so powerful because, doing the trade, opening the trade is only, one aspect of successful trading and successful utilization of options in your trading strategies. And constantly evaluating that open position, because options are dynamic instruments. They change with the passage of time, with changing prices, is critically important. So I just really wanted to take some time to say how important it is that people do look at their open positions, and they look at them with a critical eye to say, hey, is this time to close this trade or to perhaps roll this trade? And, I know you wanted me to define what a roll actually is. But what a roll quite simply is taking an existing options position, an open option position, and adjusting it and moving it to another potential option, or another a new position, closing the one and opening another.
Okay, all good stuff there. Thank you. Let me. So, why and when would an investor roll? I mean, what's the thinking, from your perspective?
So I think, again, it starts with that position that you have in your portfolio. You should take a critical eye to it. You should look at that position, look at the current price, look at the current strike price relative to the stock price, look at the current term, how much time is left. All three aspects, critically important. And you should say, if I didn't have this position on, would I open it today at the current price? And if the answer is no, your brain, your process, your trading process should be thinking, well, what would I put on? And you should think, and you should have the mindset that if you're not willing to open, if again, divorce your positions from your thought process and say, if I didn't have this position on, would I sell these calls at 10 cents? And more than likely, the answer is going to be no in a lot of cases, in which case that's going to be the alert, the alarm that says, I want to adjust this position. I want to roll this position.
Boy, do I love the way you're talking about this. I mean, what a great approach. Do I want this position? Boy, oh boy, how many times have we kept positions that just tear out our heart as it goes the wrong way and not adjust as aggressively as we should. So that's outstanding.
Absolutely. Taking a critical eye to your positions each and every day is a discipline that has to definitely be learned, because when you make a decision and you enter into a trade, you are investing. I'm kind of big into the psychology of trading and the psychology of risk management, and all back on the floor in the day, they said, "Oh, never get married to your positions," because they won't necessarily treat you right. You got to have that critical eye to look at those positions and say, "Okay, I entered this position for a specific reason. If it's no longer fulfilling that utility function, it's time to roll."
And is it hard to roll?
Oh, that's the most wonderful thing that makes the golden rule so golden, is the options market nowadays. It's never been a better time to be an investor in the options market. Extreme liquidity, commissions have never been lower. The technology is fantastic. So you can immediately see your positions, your risk, your reward potential, and the liquidity is the key point. In doing a roll, you're talking about using a spread to do a roll, closing one option, open another option, and the liquidity on both the single individual legs and then the spread, by definition, has never been better, has never been a tighter bid-ask spread. The spreads may look a little bit wide, but you can always roll in the middle of the market.
So the execution sounds like might be the easy part of the roll. The more difficult part might be that aspect that you like to spend some time on, that psychological aspect of actually pulling the trigger to make that adjustment.
Absolutely, because whether you are currently up money or down money, it's irregardless. That critical approach to the current position that you're in should be, is this doing for me what I wanted it to do for me? If I didn't have this position on, would I open it today? And if the answer is no, you really should consider rolling it to an option that you would put on today. So again, you have this position, and this is the sort of the process that I go through. You have a position. You say, you know what, this one is no longer. Let's take a position that went against you even. This position, I sold a call option on Bank of America at $13.50 when the stock was trading at 12.50 or 13, and now it's in the money. I think I haven't looked at bank in a while. Yeah, it's $14, 50 cents in the money, right? If I were to come into the market today and say, hey, do I want to overwrite the 13.50 call on my Bank of America stock trading 14.03? The answer is no. So I may have sold that at 25 cents. Now it's worth 50 cents. Irregardless, doesn't matter. Let's put that. Do I want to stay long Bank America? Yep. Do I want to continue to have an overwrite strategy where I have some extrinsic value that might experience some decay as time passes? Yes. Then the role is then, okay, go find the option that I would sell at this point. And now it may be the 14.5 call. It might be out in June, might be out in July, might be, a couple weeks. Find the option that I want to sell. The OptionsHouse platform, actually, if I can do a little bit of advertising, makes rolling, integrates rolling into that position management. So it makes it really easy. And the technology that customers have nowadays definitely will make rolling easy, where you can buy to close the one, sell to open the new one, and it's one trade, and you're set and you're done and you're good to go. And you're now into an option that's actually got the utility function that you want.
And do you have any general guidelines? I mean, what you get up in the morning and, things have changed. And let's not talk about some extreme gap, but, maybe, the overall direction of an underlying has changed going against what you think. Do you have guidelines or rules where, you decide, hey, it's time to roll? Or is that a very individual, kind of thing?
No, I think that definitely enters into the equation. Obviously, expiration is a rule-based rolling event. Today's, the May 6th weekly expiration. I tend to not wait until the last day because options change very dramatically the last day, and because I've got that critical approach to looking at my positions, I find that my positions, the utility function to me of my existing positions changes well before expiration day. But clearly as expiration approaches, that's a rule that says, hey, these expired this week within 5 trading days. I am going to take an extremely critical look at those and say, am I closing this position? Am I rolling it? So expiration's first and foremost, because time is running out.
And if time isn't the factor, again, if the underlying maybe starts to move in a different direction, is technical analysis something that you look to or not at all?
Technical analysis will be more appropriate for my underlying view on the underlying. Again, options being a derivative instrument are based on that underlying, right? So that'll be more of an input into, am I rolling this position and staying in the underlying, or am I just simply closing this position? Maybe the support that I saw to the downside, which led to me selling a cash secured put, has been breached. So now that technical reason for being in the trade no longer exists. Take your loss, and that one I would probably just close and say, wow, technically this is no longer a solid name to be in. I don't want to have positive exposure to this. Just simply close it and do not roll it. Now, if the support did hold, and the cash secured put that I sold at $2 is now trading at 10 cents, again, that critical eye, I always come back to it. Would I open and sell a 10-cent option right here and now? Absolutely not, but I still like the stock. The stock's looking strong. I would consider rolling that short put, buying it back at 10 cents because the utility function is no longer there for me. My potential reward is only $10. My potential loss is I'm short a put to the downside. My potential loss is significant. I would consider rolling that trade because the underlying is still technically looking strong, and so it definitely enters in is the short answer.
Okay. And you and I, we both spent a lot of years on the floor, so technical analysis is something that, we leaned on quite a bit. But I know a lot of the investors out there aren't, they haven't done this full time, so they aren't too comfortable with technical analysis. Are there other catalysts for closing versus rolling? Might it be, just looking at your potential profit or loss? Is that a catalyst? I mean, how do you approach it?
I think that is the most basic. I'm jumping in. I'm sorry to jump in. I'm just so excited because I think if you can. The Cubs are doing great this year, and one of their sayings is do simple. The Cubs, you've heard of the Cubs. they're in a small little baseball team in Chicago that hasn't had a lot of success over the last 100 and some years.
We'll do a show on that, in the future.
Okay. Anyway, they say do simple better. And when you say you look at the premiums, you look at the risk versus the reward, is that a catalyst? If you can just focus in on that, and that's the utility function, right? You entered into the trade because it had a potential risk reward that you thought was beneficial, that fit your market bias. Now as that changed, the idea of a small premium option, right? For option sellers, they sell premium, they look to collect that premium over time. When that premium has decreased to the point where now the potential reward is like I referenced 10 cents, and the potential, risk is still significant to the downside or to the upside if you're short a call or a credit spread. Why do you have it on? It's all risk and very little reward. And I think this actually leads to another psychological, philosophical barrier that a lot of new to option traders face is they say, yeah, but it's worthless. It's worth zero. Yeah, it probably is, right? Until it's not. And when I was learning options, I lost so much money trying to make the last 5 cents, trying to make the last 8 cents in an option that I can't tell you the number of times. And another thing for the more advanced traders, they'll look at it and they'll say, yeah, but that 10-cent option, that has a huge implied volatility. It has 4 days to go to expiration. It's still trading 10 cents, and the implied volatility is a 32. It's a downside put. It's a 32% implied volatility. The put I'm going to sell is only a 22% volatility. And I would caution people against using implied volatility as a measure of value for really short-dated options, for options you're considering closing, because again, keep it simple. Do simple better. Look at the amount of money that you can still make, your potential reward, compare it to the potential risk, and you can say, yeah, but there's no risk because it can't go down there. Trust me, it can, and it does. When we were talking about crashes at the onset, it can and it does.
And trust me, listeners, you have the ability to listen to this show over and over. What Steve just said is priceless. Absolutely priceless. So, again, Steve, it's great having you on here because of, the practical application of risk versus reward, the different profiles. And you lay it out beautifully. One thing I want to just touch on, it's a little nuanced before we wrap it up, and that is, and maybe more towards, the more sophisticated investors, implied volatility. Does it come into play when we're talking about rolling a position?
That's what I was just sort of referencing, right? Because as these smaller premium options come closer and closer to expiration, the implied volatility of that number tends to increase. So what I really want to do is caution our folks not to get too caught up in the implied volatility of closing of a low premium option. It's going to have a high implied volatility, but volatility really for a shorter term option inside of a week, inside of a couple weeks, it's no longer implied volatility is a measure of variance over time. And all of a sudden you compress that time. Now it's really just a supply and demand issue, which, yeah, there are other people out there that are short those options that say, you know what, it's not worth it to be short. I am going to pay 10 cents no matter what to close those options. Those are the more professional investors that are ignoring the implied volatility level that they're paying to close an option and simply looking at the utility function and perhaps the implied volatility of the option that they're now opening and making sure that fits their market opinions.
And that option that they are likely opening is, from a dollar standpoint, far more expensive, albeit maybe a lower implied, but a much greater credit to the portfolio.
And a greater credit means more potential reward to offset the risk that you're taking being short the option. I mean, if they can take away one thing from this little session, it is short small premium options are all risk and very little reward.
Well, we could close on that, unless there's something you would like to add, Steve.
I will tell you, it's never been better to be a retail investor in options. The playing field's never been more level. The bid-ask spreads are so tight. Commissions technology, as I mentioned, are as low as they've ever been in the history of options. I've been around for a long time, I know. And the technology is just world-class now. And I just encourage people to actively manage their positions, their open positions, with a super critical eye. Take the emotion out of it, and our most successful traders are the ones that actively roll, adjust, and close those open positions.
Well, listeners, there you go. That's Steve Claussen, Chief Investment Strategist at OptionsHouse. Steve, can't thank you enough. Appreciate your time today.
Thank you, Joe. Always great to talk to you.
And that's it for today's Strategy Spotlight.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Jeff Hirsch, a thought leader in market history and seasonality, and also editor of the Stock Traders Almanac. Welcome, Jeff.
Great to be with you, Joe. How are you?
Doing fantastic. Thanks so much for making time. Really happy to be able to offer your expertise and the history of the family business to our listeners. So how about if I just start off by asking you if you would tell our listeners a little bit about the history of the Stock Traders Almanac?
Sure. Well, my illustrious father, Yale Hirsch, who is 92 at the moment, in not too far away from me in Nyack, he was in the songwriting business, working with his cousin and my cousin, Sam Kozlow, who wrote Cocktails for Two and My Old Flame. And Sam had sold his music publishing business to the it was RCA for some stock, got burned in the crash way back.
Which crash?
No, like the one in like 29, I believe. Or maybe it was shortly thereafter during the Depression. Sam was an older cousin.
Yep.
But he was a student of markets since then, of market indicators. He started a publication called Indicator Digest in 1961 out of Palisades Park, New Jersey. They were living in Englewood, and he called on Yale to be his head of operations. And Yale immersed himself in the business, both the marketing and advertising side, as well as the editorial and analytical research side. Several years later, Yale went out on his own and to take all of these indicators and organize them together in a sort of calendar format, which became the Stock Traders Almanac. And he incorporated in 66, put out the first edition in 67, which was a 68 Almanac. And the rest, as we say, is history. There's more in between, but we are now celebrating, or about to celebrate, our 50th anniversary edition, which will be the 2017 edition, and that should be off to the publisher in a few weeks.
So spectacular. I mean, you talk about, just a couple great things there. You got a great family business. You got all this expertise in market history. I mean, it's just very exciting celebrating your 50th year. Tell me a little bit about what you learned from your dad, Yale.
Aside from, market analysis, historical seasonal cycle stuff, we pick stocks as well, and we do some fundamental technical screens these days. But one of the first things he taught me was price to sales ratio in analyzing a stock. Now, I mean, he was a value, buying underpriced, out of favor, undervalued equities. So, we were looking for stocks that had a price to sales of 1 or less. So you were basically buying the value of the company, the sales at a discount. Again, in addition to the seasonal and sort of way we look at the market, which I can tell you in a second, also marketing. One of the quotes that he had, hanging on our in front of our desks was from Jimmy Three Sticks Robinson. I think it's marketing is our number one priority. If it doesn't grow the business, we should be spending our time on it. So it's always about direct mail testing and writing headlines and grabbing people's attention. So that was a real proponent of what we did, a real component of what we did. And he was a master of it with the way with his songwriting talents.
And I mean, that's interesting because if we go back to, you said your dad incorporated in '66, those were things that, certainly were more difficult to achieve,
Mm-hmm.
The whole idea of marketing versus, the way it is today.
Well, you still got to always be testing, and it's all about price testing and offer testing and headline testing. And we learned to run these things we called day sheets and cum sheets, using a piece of graph paper tracking orders and things and revenue that came in by code and on dates. And if you run a big, we used to run ads in the newspaper when that was in vogue. And if you went out with a full page ad in the newspaper, on the day the market gets slammed, you got to take that into consideration. Like maybe the ad didn't just not work, or it was just a bad day on the market. And then we added a photograph, a picture VL to the ad, tripled returns, a lot of sort of promotion and marketing and advertising things I learned. In addition to looking at seasonalities in a very iconic way, which is I think his legacy and will be his legacy, in the marketplace, is just a different way of looking at things, a different way of understanding human behavior with the beginnings and ends of things and the middles of things, and the cultural, behavioral activities and behaviors of individuals and collectively as a market or a society. So.
Well, I do want to get into, your different approaches to looking at things, but one more question, I think, about the family business. Was there a hot button, or, what made you decide to, pursue the family business?
It was my best friend, Keith. He kind of grabbed me by the collar and said, "What are you doing? Go work for your father." Back in about the fall of 1989, I was sort of avoiding it and trying to, make my own way. And my buddy sort of knocked some sense in me and told me to go work for Pop.
Outstanding. Well, you mentioned, some different approaches. You got the historic seasonality. You've got the technical and fundamental analysis. Is one of those approaches most important? Is there a progression to how you look at things? Tell our listeners how you go about your business.
Oh, well, I mean, it's kind of like the same kind of interviews you have with songwriters, rock and roll people. You have a way that you generally have a bias. Like our bias is seasonals and history and cycles. But wherever the idea comes from, there's the age-old method of looking into a stock where you find the new product you like. Some things will show up technically first. I'll recognize a chart pattern. We'll pull out things from a fundamental screen or an analysis on an individual sector or stock. So mostly we start from history and cycles and seasonals, and then go sort of break things down technically and fundamental. But I'll see things technically as a starting point, and or fundamentally as a starting point on any given investment, depending upon, what we're looking at that time. For doing a stock screen, I mean, for example, we, select stocks throughout the year, but for the most part, we're getting long around September, October, and lightening up around this, April, May, June time frame, and getting short. So, we're not just picking stocks to get long any time of the year. We're looking to get long right at that, October low, October being the best time to buy stocks, and we try to get in a little bit early. So, yeah, I mean, a seasonal bias for the most part.
So, we referenced Stock Trader's Almanac, but, we haven't talked too much about it. I mean, and maybe, through this question, you can get into some of the specifics. I mean, there must be a finite number of seasonality trends over the course of 12 months?
It depends upon what market you're looking at. I mean, if you could, you get in all the different commodity complexes and the different individual commodities. Each one of those has their own seasonality. Small caps and techs have a slightly different seasonality than large caps, in different stock sectors. So, I mean, it's finite, but it's pretty broad and pretty wide, and it changes depending upon the year, the interest rate, Fed policy cycle that you're in. So we're always looking for things. Some are short term. There's intraday patterns that we track when taking a position or getting out of one, which is one of the things I find most amazing, despite all this high frequency trading and which to me, I don't know. You remember the old days of market making when people were shaving steents and eighths on things. Now they got to fight for hundreds of cents. So
yes.
I don't see how it's any worse, or I think it was easier to manipulate things when you had a couple guys making a deal on an eighth of a point, splitting that between them, than it is when the machines are shaving, thousands of pennies. So despite all that stuff, the intraday trading patterns that are based upon the daily habits of collective individuals has not changed and still persists with that 230 lull and that rally to the close, weakness at the open. I mean, that's right in the omen. I mean, that was one of the first things I started crunching numbers for with my father back when I was in high school, over the summer or, on weekends and stuff, earning my keep around the house and maybe getting some allowance or something. I would run in the Barron's Lab pages, we would underline each half-hourly uptick with a little red line and this little tiny short ruler, and I'd go through and add them all up using an old-fashioned adding machine and graph paper. Now, SQL Server, Visual Basic, it's programmed to do that for us.
Yeah, well, as you know, I spent a lot of years on the floor myself, and I couldn't agree more. A lot of the noise has changed around the market, but the way the market trades, to me, just doesn't change year after year. I mean, the same tendencies persist over and over and over again.
However, there's a big seasonal change. This time of year in May, we get a lot of testing or questioning of the best 6 months switching strategy, which everyone calls sell in May now because of the old British saw, which we can get into, but we don't have to. And a recent study somebody did showing sell in May doesn't work in election years. They go back to 1900. Well, sell in May didn't work before 1950 because we lived in an agrarian society with farming and agriculture fueling most of the economy. And the chart that I present to people, probably ad nauseum at this point when I do it at shows and webinars and that sort of thing, is a one-year seasonal pattern of the market, with one line being 1900 to 1949 and one being 1950 to the present and then 1988 to the present. And we try to do it post-87 crash to compare the current, to the shorter-term trend to the longer-term trend. And it's inverse. It's basically buy in May back then because all the money would come into the economy with planting and sowing and hiring of workers and fuel and machinery, and you could see it sort of peak out around September, October after the harvest. So things do change.
And with regards to, you're talking about the seasonality in the April-May period. Are there other trends setting up now, and if we stick to kind of the stock market as opposed to the futures market, any other strong trends?
Strong uptrends
or down, either way, trend period.
The utilities market tends to stay strong. We picked that up on a little bit of a dip, like the XLU, it just representing the broad utility sector. That's strong sort of March through October. Material sectors are really good short May through October. That's one of the most consistent sector seasonalities, being long October to May and short May through October. And then the sort of NASDAQ, tech stock, Russell 2000, best 8 months ends in June. And what we start to get into some short stocks. We've put a few shorts out there. We've had a few select, securities that look overvalued and breaking down in the transports, financials, and materials area. So that's where we sort of combined seasonality with fundamental analysis and technicals, where we're seeing the general sell in May period, some weakness in the financials, transports, and material sectors, and a few stocks, a handful of stocks in those sectors that are overvalued, breaking down, having earnings misses that look like attractive shorts on either a failure at resistance or a breakdown through support.
Do you incorporate options, in your, different dialogues?
I don't personally. I have not had much success with options myself, but I know what we do, and I know how people use them that do incorporate options into their trades, that the setups and the directional analysis that we provide people makes for great opportunities in for people to implement their own strategies. Our buddy John Person has done a lot with, having done the Commodity Traders Almanac with him for a bunch of years. He's, put together some really nice options trades, seasonal oriented options trades, but that's something I don't personally do myself.
Okay, but that's where, of course, some of the OIC Options Industry Council education can come in as well, in conjunction with Mr. John. Let me ask you this, Jeff.
Yep.
I know you're going to offer, a full 1-hour presentation at our upcoming June webinar event. Yeah, you have some ideas? I mean, it's going to focus on the election and market volatility. Any teaser for our listeners to be sure that they get a full hour of your expertise?
I mean, I think the crucial part of this is the fact that this is a, open election, the 8th year of a president's term, which has proved to be much weaker and downright treacherous for the stock market. Granted, we haven't had as many instances, to statistically incorporate, but the second election year has been troubled. So you have a lame duck president. We've got a pretty crazy campaign cycle here and a campaign, environment, and I think that's going to be playing into weakness up through the elections, up through the conventions, as well as, the usual end of election years being strong might, be tempered by the sort of two likely unfavorable candidates that we will be choosing from in November. So I'll be talking a lot about that, and then the future. I mean, my long-term forecast, it's going to be a little bit more about not just this election year, the rest of this year, but about the next couple of years, the post-election year, midterm year, which are crucial and somewhat rocky years for the election cycle. But I've also got my long-term forecast for a big secular bull market beginning, but not until after another official cyclical bear market, maybe a 20 to 30% drop. 20.
Okay. Well, that we're looking forward to getting, more of that detail on the 21st of June. I know that, you've written a number of books, and one of them does talk about that long-term bull target. And, like you, I hope we get there one of these days. Any closing thought? One thing I do want to be sure is tell our listeners how they can find your information, reach your business. Let us know that.
Well, a simple way is our website, stocktradersalmanac.com. Everything you can find about us there is a link through to the blog, which is hosted on Tumblr. We also are Almanac Trader or at Almanac Trader on Twitter. A lot of action on there, which is fun and informative. And right now, there's we can offer people a little 50th anniversary special on our newsletter subscription. You get both the 16 Almanac and 2017 Almanac. It'll be $150 for 1 year, $250 for 2 years. If you want to reach out to us, and we'll send you the code for that.
All right. Well, I hope our listeners caught all that. Any final thoughts on things going forward here?
Well, as I said, we've already, begun trimming underperforming positions and getting short a couple of things, getting into some bonds. I know we had had some nice rallies, and we've had some big sell-offs. So the market's looking like it's getting ready to roll over here. So I think it's time to either be defensive or get to some cash and ride this storm out until we see what happens after the potentially tumultuous Republican convention, and also look for some weakness over the next couple of years. So it's going to be rough sailing. We've had a pretty straight solid up move over the past few years, and I think that's about to change.
Time will tell, Jeff. We appreciate you joining us today on Profiles and Perspectives, and we really are looking forward to you and your offering on June 21st at the OIC Summit. So thanks for joining us.
I am too, Joe. Thank you for having me.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, we're going to the same source for our tool and resource. That source is our website, optionseducation.org. Both the tool and resource can be found in the same area of the site. Go to the Tools and Resources drop-down bar, and you'll find this month's tool under Historical and Implied Volatility. Please check out these one-year implied vol charts on your favorite stock, index, or ETF. These charts will give you a sense of option premium levels over the entire last 12-month period or 1 year. The resource tab in the same drop-down will take you to the covered call calculator, this month's resource. This interactive calculator will allow you to calculate returns on covered calls again with your favorite stock, index, or ETF. And for today's good reads, I'm going to highlight a few of the books from our Profile and Perspectives guest this month, Jeff Hirsch. Jeff has written Stock Trader's Almanac, Seasonal Sector Trading Strategies, and a stock market cycle book, how to use them for short and long-term profits, in addition to a few others. Jeff's got quite a collection. I suggest you check them out if you have a chance. That's it for today's tools, resources, and good reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, we're going to respond to a Facebook question from Alex. What are your thoughts on shorting a 1-year 25 delta put on LNKD, which was 105 at the time of this question? It's quite a bit higher now. Puts are quite juicy right now and quite acceptable break-even points. I'm very interested in hearing your feedback on selling long-term premium versus short-term premium. Well, as a reminder, and I think all our listeners know, OIC cannot give any investment advice. So I won't be answering the specifics of this question, nor really opining on the security itself, but I will speak more broadly to the issues raised. It's really a great question, Alex. So let me start by saying you've touched on a lot of points. Selling options naked versus not in a spread, that's one point. How do you feel about selling the 25 delta put? The second point, you made was the prices are juicy. And then I think lastly, you were looking for some feedback on selling long-term versus short-term premium. Let's start with number one, selling a 25 delta put. Well, as is often the case with questions I get both on the show and when we're doing live presentations, investors are looking for black and white answers. And frankly, oftentimes that's not possible. And I go back to there are so many variables out there. What is an investor's risk tolerance? What is their capacity? So I'm going to go back to selling puts naked and ask you, what is your capacity for risk? I personally like to trade spreads because when we trade a spread, we quantify our risk. Selling, a naked put or a call, even if it's juicy, can be good until something goes wrong. And certainly, the security that was mentioned has been more than chopped in half, in the last year. So, maybe the time is good now. But for me personally, my approach is to trade in a spread capacity so I have defined risk versus reward. That's number one. You mentioned juicy prices, suggesting that the premiums are higher. And in fact, they are based on the implied volatility charts. And again, we talked about the implied volatility charts in our tool, in our other segment today. You can find those charts at optionseducation.org. You'll get a sense for how much the premiums in options have expanded or contracted over the last year. That's a way for you to really make a decision on whether you think the premiums are high or low. But again, if you're selling naked options, you have to be aware of the risk. And then the last point that Alex raised was selling long-term premium versus short-term premium. And again, I'm going to go back to it really depends on the philosophy of the individual investor. One thing I know, I always, if I'm selling premium, I am going to refer to those implied volatility charts because I want a sense of whether the premiums are maybe to the low side, midpoint, or high, and then decide, what options I may want to sell. And whether it's short-term or long-term, again, I get back to, what's the philosophy of the individual investor? If we're talking long-term, we're incorporating a number of earning cycles and the potential risk there. So if you're selling long-term, you have to be willing to accept, obviously, more risks over a longer period of time than a short-term option. So with that, I'd like to thank Alex for his very insightful question today, which touched on a lot of broad topics. And I invite our listeners, as always, to please send your questions. We really appreciate getting them, answering them, and we look forward to, answering quite a bit more. I'm going to say this again, blah, blah, blah. I want to thank Alex for sending his insightful question today. It touched on a lot of different topics. Please do continue to send your questions to the Options Insider Network here at Wide World of Options, and we look forward to answering many more questions in our Looking Back segment as we produce more and more of these shows down the road. Thank you, Alex.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.